Section 7 is an important section for us, but it is important to remember from the start that it is not a section that is only applicable to trusts. This is a common mistake that students make because they quite often ask Section 7 in trust questions, but it's incidental to the fact. Section 7 is not applicable only to trusts. It is applicable whenever there is a donation, settlement, or other similar disposition. These are the words that you'll see in the Act in Section 7. So basically what that means is, if there's a donation, then you should consider Section 7. Now what Section 7 does is it prevents people from avoiding or reducing or deferring or transferring their liabilities for tax. So, for example, and this is the concept that you need to understand now the whole time. We have a person here, Mr. X, and I'm going to call him from the start now the donor. Now understand, to be a donor, you either donate something, and we know what a donation is. I donate something to you, you take it. Right, donation as we know a donation. Or it is a low interest loan. Now, a low interest loan means either they don't charge you any interest or they don't charge you enough interest. So if they sell it, so there's an asset, let's say, and the market value of this asset is 1 million rands. If you sell it to someone or to a trust, but you sell it to someone, this Mr. X, and he doesn't charge any interest, but he sells it at market value, there is still a donation, and that will be the interest that's not charged. That's the concept that you will encounter a little bit. Okay, but for now, just understand that Mr. X donates an asset. Right, so donates, he either donates it or it's a low interest loan. This is the concept that we are looking at now. Now this asset over here, let's say that this is a property and it earns rental income per year of 100,000 rands. Okay, so any asset, so an asset that generates income, tree that produces fruit, that concept. So Mr. X donates this asset, which is a property, which earns rental income. And over here is another person, and let's call this person for now Child X. And say Child X is 6 years old. Okay, now, what I want you to understand, what we'll see now in these sections, is that if Section 7 applies, the donor is taxed. Right, so Mr. X. Okay, so now understand what happens. So Mr. X goes, he donates an asset to Child X. Right, so I want you to see, make sure you listen to what I'm saying here. I'm not putting in a trust at all. There's no trust. So Mr. X donates the asset to Child X. Child X is his child who is 6 years old. So Child X, this rental income that you see over here, will be going to Child X. Will be paid into Child X's bank account. Child X, understand, is the legal owner of that income. Child X could theoretically take his parent to court, Mr. X, if he doesn't receive the money, because he's now the owner. He has become the owner of that asset, and he has become the owner of the income. You basically have a vested right to the income. If you have an asset, you always have a vested right to it because you are the owner of it, right? Unless you've given away the right to own ownership, the income from it, so you've ceded it. But right, so we're not looking at something strange like that. I want you to understand, Mr. X donates an asset to Child X. Child X earns 100,000 rands. The reason why Mr. X can do it can be for a variety of reasons. He might want to give Child X an asset as a birthday present. He might have a different reason. He might say, this 100,000 rands, maybe Mr. X is being taxed at the highest tax bracket, 45%, and Child X will be taxed at 18%. So Mr. X is saying, instead of, just think about this income here, this 100,000 here, instead of this income, 100,000 rands, less tax, we'll get out 55,000 rands, right? Just roughly speaking, obviously, we'll get out 55,000 rands. But if I give it to my child, then we will have how much? 72,000 rands. So can you see? The family will save money. So there's all sorts of reasons why a person might want to do this. But this is not something that SARS likes. They don't want people to start entering into schemes like this. Now you'll see if you read Section 7, Section 7 doesn't talk about, in all instances, there's an instance if you refer to spouses, where it talks about tax avoidance, but in all other instances it doesn't talk about it. Basically, they just describe situations and scenarios. So they've tried to write in Section 7 situations to stop this from happening. So, if Section 7 applies, so here will be a Section 7 that applies, and that will be Section 7.3. I want you to understand that what will happen. If we now do our gross income, your taxable income calculation, so here's our rands column, Mr. X will include the 100,000 rands in his income in terms of Section 7.3. So we override the normal rules around income tax. So understand what I'm saying there? I'm going to repeat that. Mr. X donated an asset to Child X. Child X then earns 100,000 rands from that asset. However, because there was a donation and Section 7 applies, we'll look at all the different Section 7s that are applicable, but just understand for now Section 7 applies. Because a Section 7 applies, instead of Child X being taxed on it, Mr. X, the donor, will be taxed on it, which is what we see here. Okay, so now just to give you a little bit of perspective, if there was no, so let's change this up here. Let's actually keep it as first like this. Actually, I'm going to keep it like this scenario where Mr. X has donated an asset to Child X. We keep the same situation. However, for now, for some reason, just accept this please, but for now, for some reason, Section 7 does not apply. So if Section 7 does not apply, then Child X receives the 100,000 rands, and it is not Mr. X that will be taxed, but Child X that will be taxed on the 100,000 rands. So what am I saying here? If there was a donation and Section 7 does apply, the donor is taxed. If it does not apply, whoever earns the income is taxed as normal. Right, so that's now the one situation there. Next situation, instead of Mr. X donating this asset, he sells the asset. Proper sale. Alright, there's no donor in this case. Just understand, he sells it to Child X for R1,000,000 rands. He charges the correct amount of interest. It's a proper market-related transaction. I know it seems strange that you sell it to your child, but remember there can be a loan, an outstanding loan account. Okay, between family members you can obviously do it, but let's say that loan account is market-related, so there's interest that accumulates for Child X. Okay, understand this, it's market-related. That's what I want to carry across here. Right, we can make Child X older, 16 years, 26 years, whatever the case might be, but there's a proper sale. If there's a proper sale, Child X is the owner of the asset, and Child X will be taxed on the income. What you see over here. So what am I trying to say to you? When there was a donation, you have to consider this Section 7, but when it's a proper sale, you don't even consider that, just whoever owns the asset gets taxed on it. Okay. Then, one more situation and scenario here, just for you to understand. Mr. X now donates the asset again, but now he doesn't donate the asset to Child X, he donates it to a trust. And the trust gives the 100,000 rands to Child X. So now, what do you need to understand here? The trust is just a conduit pipe, remember that? So it means the income just flows through it. Mr. X is still a donor, there was still a donation. So we should still consider Section 7, because Section 7 applies when? When there is a donation. Not when there's a trust, but when there's a donation. So Section 7 applies because there's a donation. In this case, guys, assume that Section 7 does apply correctly. Child X receives the 100,000 rands from the trust. Right, it flows through the trust to child X, but Mr. X will still be taxed as the donor because Section 7 does apply. So it won't be child X again, it will be back again to Mr. X. Right, and let's whatever, some sort of Section 7 will apply. So again, the concept that I'm trying to carry across, and which you'll see with all of the Section 7s which you're going to look at now, is that if there was a donation and Section 7 applies, then the donor is taxed. Right, the donor is taxed. So that's the concept. Again, if there was a donation and Section 7 applies, the donor is taxed. So what we're going to look at now is all the different Section 7s which are in your syllabus. Before we look at it, just one more comment here. Please note, guys, that the donor can only be taxed if he was alive at the time that the donation took place, and also at the time when the income was earned. So for example, if there's a block of flats that produces rental income on a monthly basis, and Mr. X was alive only for the first 4 months of the year, then he can only be subject to Section 7 for the first 4 months that he was alive. So you can't tax a person who has passed away. Right. So, first up, Section 7. Section 7 says, income shall be deemed to have accrued to a person, notwithstanding that such income has been invested, accumulated, or otherwise capitalized by him, right? Or that such income has not been actually paid over to him, but remains due and payable to him or has been credited in account or reinvested or accumulated or capitalized or otherwise dealt with in his name or on his behalf, and a complete statement of all such income shall be included by any person in the returns rendered by him under this Act. Alright, what are they saying there? They are saying, you will be taxed on income. Right? Income shall be deemed to have accrued to a person. Even if that, so this notwithstanding means even if that income has been invested, accumulated, or otherwise capitalized by him, or not actually been paid over to him. So what they're trying to say is, if you have a vested right to income, then it will be taxed in your hands, even if you have not received it. Okay, so I'm going to write it here. If you have a vested right, and by you we mean a beneficiary, you will be taxed on it, even if it has not been paid out to you. So not being paid out to you. So what they are, I'm going to just explain to you why we often see this with a trust question. So there's a trust and it has an asset that has income of 100,000 rands each year. The trust deed says here's a beneficiary. Right? The trustee says A has a vested right. So just understand what I'm saying there. It is already a proper vested right. So I'm not going to explain the whole situation. It is a vested right to the income, but only pay out in 5 years. Okay, let's just say that. So what I'm trying to just say here is A definitely has a vested right, so it'll be paid into her estate if she dies. She has a vested right to this income, but it will only pay out in 5 years. So each year, the asset makes 100,000 rands income, but it stays in the bank account of the trust. It does not get paid out to A. It will only be paid out in 5 years' time. That income will still be taxed in the hands of A because A has a vested right to it, even if it has not been paid out. That's what Section 7 says. So we'll now look at other Section 7s that will say, okay, no, if there's a donor, that person must be taxed. But Section 7 just tries to tell you, in all situations, whoever has a vested right to it, or whoever should be taxed on it, even if they haven't received the money. That's what they're trying to say. You can get taxed even if you have not received the money. Right, so here's our first section that we have to talk about, Section 7.2. Now, part of this is excluded from the syllabus, but it's an important section to see. Part of it is included, so we're going to just talk about Section 7.2. Section 7.2 is a section that applies to spouses. Right, so it says, any income received by or accrued to any person married in or out, I want you to see that, in or out of community of property, hereinafter refers to this recipient, shall be deemed for the purpose of this act to be the income accrued to such person's spouse, referred to as the donor if. Okay, so what they are saying here is Mrs. X and here is Mr. X. Right, they are spouses, married. Mrs. X, right, is the donor. So what we're trying to say here, and what we're going to see, is situations where Mr. X receives income, but it will be taxed in the hands of Mrs. X. Let's draw it that way around. Okay, so they say, what are these situations? The first one is, such income was derived by the recipient. So the recipient is the person who receives the actual income, so Mr. X, in consequence of a donation, settlement, or other disposition. Can you see Section 7 talking about this donations again? Made by the donor, and important here, and the sole or main purpose of such donation. This is very important to see. The sole or main purpose of such donation was the reduction, postponement, or avoidance of the donor's liability for any tax. So what they're trying to say here is, let's say Mrs. X pays tax at 45% and Mr. X pays tax at 28%. Let's just say that's the tax rates. Mrs. X donates an asset that earns 100,000 rands a year to Mr. X because Mr. X can then be taxed on 28% instead of Mrs. X being taxed at 45%. They're married, so they can share the profits basically, obviously informally. Section 7.2 says, if the sole or main reason for this donation was to avoid tax, then instead of Mr. X being taxed on it, Mrs. X will be taxed on it. Now, this is obviously something that I'll have to indicate in the question for you. Mrs. X, understand what I mean by this. Mrs. X can go and donate an asset to Mr. X, and there can be a tax saving like this. But if she can prove that it was not the sole or main reason was to avoid tax, if she can prove that, then there will be no Section 7.2 consequence. So understand, they must prove it. This is the only Section 7 that works like that, by the way, where they have this in. The rest of them ignore the fact they don't care if you make a profit or a saving or not. Right, that's there. Then Section 7.2b, which is important. In Section 7.2b, this is where spouses trade together. So basically, this is where spouses work together. So they say, if income was received to the recipient from any trade carried on by the recipient in partnership with the donor, or from the donor in any partnership of which the donor was at such time received to accrue a member, or any private company where the donor was the sole main holder of shares, and such income represents the whole or any portion of the total income so received by or accrued to the recipient, which exceeds the amount of income to which the recipient would reasonably be entitled, having regard to the nature of the relevant trade. So what they're saying is the following. Let's say Mrs. A and Mr. A are in a partnership, so they do have business together. Mrs. A is entitled to 70% of the profits, and Mr. A is entitled to 30% of the profits. The profits for the year is 100,000 rands. Okay, so how much is Mrs. A entitled to? Just going to put it in a different color here. She is entitled to 70,000 rands. Mr. A is entitled to 30,000. So I'm going to write there entitled. However, they decide actual payout. They decide to do the following. to say that Mrs. A must only take 20,000 rands and Mr. A can take 80,000 rands. So understand what I'm saying here. There's 100,000 rands profit. Per the partnership agreement or the nature of the business, from the work carried on by Mrs. A compared to the work carried on by Mr. A, whatever way you look at it, right? There's going to be some standard and something that is not agreeing to it. So in this standard, it says that Mrs. A should get 70% of the profit and Mr. A 30%. So Mrs. A should get 70,000 and Mr. A should get 30,000. However, they decide that Mrs. A will get 20,000 rands and Mr. A will get 80,000 rands. So they pay out in different amounts. What section 7.2b says is, no, you can't do this. So what will happen is Mr. A and Mrs. A must be taxed on the amounts which the business ratios or the business demands them to be on. So Mr. A should be taxed on the 30,000 and Mrs. A should be taxed on the 70,000. So we ignore the actual payout. Right. Section 7.3, minor children. Okay. Now, what is a minor child? A minor child is a child that is younger than 18 and a child which has never been married. So if you were married when you were 16 years old and divorced when you were 17, you are younger than 18, but you're happily married, so you're no longer a minor child. Please note also, I just need to add here, child includes a legally adopted child. Okay, so just please remember that. Legally adopted child as well. I just want to add it there as well. Okay, so what does section 7.3 talk about? Section 7.3 talks about a situation where there's a person, Mrs. A, and there's a child, child A. Child A is a minor child. If Mrs. A makes a donation to child A is a minor child, any income child A earns will be taxed in the hands of Mrs. A under section 7.3. Now remember again, that donation could be to a trust, and then the trust gives it to child A, same situation, Mrs. A will be taxed. Very important for you to be aware of here, and this is a common mistake students make. Please note that this only applies if the donor is a parent. So Mrs. A over here must be the parent of child A. It does not apply to grandparents, aunts, uncles, or any other family member. So if they say Mrs. A is the grandmother, right? If Mrs. A was the grandmother, then child A would be taxed on the income. Because section 7.3 cannot apply because the donor, Mrs. A, must be a parent. Very important to see that. Right, the idea behind it, just for interest's sake I suppose, is that if, let's say it like this, parent, child, and grandparent. This is basically how a family is structured, or could be structured obviously. Grandparents, parent, or child. The parent and the child, they are direct. They have a direct influence on each other, especially when the child's a minor child. If the child's a minor child, you are most of the time in charge of the child's finances. So that is why you can manipulate the situation. But if a grandparent gives to the child, there's a parent that's in the way. Now obviously families can get together and make all sorts of schemes, but that makes this section here very complicated. So that's why they've just said parents and children. Okay, so parents and children. So income shall be deemed to have been received by the parent of any minor child or stepchild, if by reason of any, see here, donation, settlement, or other disposition made by the parent of that child. Can you see the whole time, guys? Parent, 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 parent. If it has been received or accrued to in favor of that child, or has been expended for the maintenance, education, or benefit of that child. So it's very important that you see there, even money that you spend on paying for your child's education will be taxed in the hands of the donor. Now, the moment I say that, people go, what? That sounds crazy. But the idea behind it is not so crazy. What it is let's say Mrs. A, she's now the parent. Mrs. A earns a salary per year of 250,000 rands. Right? and school fees are 30,000 rands. Okay, so what this means is she can't go and say my income is actually 220,000 rands and 30,000 rands of that goes to my child for school. That's what they're trying to say. You can't do it. They say, no, Mrs. A will still be taxed on that 30,000 rands. She's the parent. So in other words, she'll be taxed on the full 250. So it's just, doesn't seem as clearly written as that, but that's what it means. They say, or if it has been accumulated. So whether or not it's been paid out, or if it has not been paid out for the child, but it is for the benefit of the child. So if they say, if you, for example, have a bank account which you've put money into, so listen carefully to this, if you've put money into a bank account for your child, so you've donated for your child, that money, that interest that is earned, you should be taxed on it. Because it's a donation that you've made, it's an asset, it's the money, the deposit, and the interest earned on it. Because even if your child hasn't paid out, so you put it in the bank, you say pay out in 20 years, you should be taxed on it every year. Okay, that's section 7.3. Section 7.5, this one is one that basically, it's not specific to trust, but you'll only see it in a trust situation. Right, or that's basically the only situation really that you can see it practically. So I'm going to explain to you first what this means. So here's a trust. This one is super easy, guys. This is the one I believe most students make mistakes in, but it's by far the easiest one. If you just understand and listen carefully to what it says here. This trust earns income of 100,000 rands. There is no beneficiary with a vested right. Okay, so understand now what happens. This trust earns 100, it has an asset in it, a block of flats, right, rental property, earns 100,000 rands a year. There is no beneficiary that has a vested right to the income. So the trustees must use discretion. And I'm just going to write here, they've not paid anything yet. So what I'm trying to say, make sure that you understand, this trust has been earning 100,000 rands each year for however long, let's say 3 years. 100,000 rands each year. The trustees must make a decision who it gets paid out to. It does not belong to anybody, so it belongs to the trust. Now, who will be taxed in that situation? The trust will be taxed on it in terms of section 25B. If there's no vested right, if there's no one who vested right, then, and it hasn't been paid out, then the trust should be taxed on it. However, the moment you put a donor into this, that it donated these flats, the moment you put a donor into it, so it's the same situation, 100,000 rands each year, it has not been paid out, so it is retained in trust, retained income. The moment there's a donor there, and if it hasn't been paid out, you remember now, you have to then always consider there's a donor, you have to consider section 7. There's a section 7.5 that says, if there's income that has not been paid out, and no one has a vested right to it, so it doesn't belong to anybody, then the donor must be taxed on it. So you won't apply section 25B, the donor will be taxed. So in other words, for the income retained in the trust, right, if someone has a vested right to it, so you're just waiting to pay it out, then that person must be taxed on it, unless some other section 7 applies. But if no one has a vested right to it, the trust will be taxed, but if there was a donation, then the donor will be taxed. Okay, so it says here, if any person has made any donation, settlement, or other disposition, which is subject to a stipulation or a condition, whether made or imposed by such person or anybody else, to the effect that the beneficiaries thereof, or some of them, shall not, so beneficiaries shall not receive the income, or some portion of the income thereunder, until the happening of some event, whether fixed or contingent. So, whether fixed or contingent. So, for example, here, the trustees must use their discretion. That's contingent. We could have also said here, this 100,000 rands must accumulate until the beneficiary, who is now, let's say, 5 years old, until the beneficiary turns 35 years old. And if the beneficiary never turns 35 years old, it never gets paid out, and then the trustees must use discretion. If you say something like that, for example, the same thing. No one would have a vested right at this point in time. Right, but then there is a fixed event. So again, just up to here, they say, if there's a donation and there's some condition, which means that beneficiaries have not received the income until something has happened. Right, whether that something is someone making a decision or whether an event must happen. They say so much of any income as would, but for such stipulation or condition, in consequence of the donation, settlement, or other disposition, be received by or accrued to in favor of the beneficiaries, shall, until the happening of the event or the death of that person, whichever first takes place, be deemed to be the income of that person. So all of this that they're talking here is they're just saying in simple terms. They say, if an amount is not being paid out to the beneficiaries because something hasn't happened yet, so either someone hasn't made a decision, or someone hasn't turned the right age, or someone hasn't gotten married, or something hasn't happened, some condition hasn't been met, then the donor will be taxed. They say that person is, remember, is this person in the beginning. If any person made a donation, so that person. So in other words, you look at the income which has been retained in the trust. If no one has a vested right to it, then the donor will be taxed on it. And then the last one, guys, very simple. Here's the donor makes a donation to a non-resident, right? The non-resident earns income. That income is taxed in the hands of the donor in terms of section 7.8. So in other words, if there's a donation that goes to a non-resident, the donor will be taxed. We don't care about the age, we don't care about anything like that, the fact that it's a non-resident. We don't want to complicate tax matters and move tax out of the South African tax system. That's basically why we try and not do it. So we don't want to do happen through donations. So again, where by reason of or in consequence of any donation, settlement, or other disposition. Can you see, guys, the whole time, donation, donation, donation. Made by any resident, any amount is received by or accrued to any person who is not a resident, which would have constituted income had that person been a resident. So they say it must still be income, so it can't be a capital gain. They shall be included in the income of that resident. Remember they said, if a resident made a donation to a person who is not a resident, then you will include it in the income of the resident. So in other words, the person who made the donation, the donor. So much of the amount as is attributable to that donation, settlement, or other disposition. Right, and that is the important part up to there that you need to consider. So guys, section 7, please remember, you have to look out if there was a donation. You can only tax the donor on it whilst the donor is alive. And there are a variety of other section 7s, but these are the ones which are currently included in your syllabus.